Welcome to the Deep Dive. Today we're jumping into the Q3 2025 earnings conference call for Anheuser-Busch InBev, that's ticker BUD. The call was back on October 30th, and well, our job today is to cut through the noise for you. We need to figure out why the market reacted so cautiously, pulling the stock down, even though there were some pretty good financial headlines and, frankly, a huge capital return announcement. It was a quarter with a real paradox at its heart, and we're going to unpack that tension between falling volumes and rising profits.
Yeah, that paradox is really the key thing here. A quick look tells the story. Strong on profit, strong on operational discipline, you could say. But, and this is the big but, weak on volume. So that market caution. It makes sense. Let's hit the headline numbers first. Underlying EPS, that came in at 0.99 cents. That was actually a slight beat versus the 0.97 consensus. However, the GAAP EPS, the official accounting number, was way lower at 0.53 cents. Tells you there was some significant one-off things going on. And revenue, critically, was a little light. $15.13 billion against a $15.22 billion expectation. So a slight miss there.
Okay, hold on. An EPS beat, but on lower than expected revenue. That sounds counterintuitive. How does that work? Is it just costs coming down or successful price hikes or something else boosting the profit?
It's a mix, but the big driver is definitely pricing power. And like I said, internal discipline. Margin expansion is the key. Their main profit measure, normalized EBITDA, hit $5.59 billion. That's up a solid 3.3% year over year. But the really crucial part, the margin, it expanded by 85 basis points. Reached 37.0%.
85 basis points.
Yeah, for a company this big, gaining almost a full percent on margin, that's a major win, driven by selling more expensive stuff, essentially. Premiumization and pricing.
Right, that sounds incredibly efficient.
Yeah.
But we know the stock fell. So you've got this great margin story, and yet the market just zoomed in on the volume problem. What did those volume numbers actually look like?
Pretty rough, actually. Organic volumes overall were down 3.7%, and beer specifically dropped 3.9%. That decline, and where it happened globally, that's what's really weighing things down, no matter how good they got at making money from the beer they did sell.
Okay, right. So let's pivot to the financial defense, maybe, because management definitely made a bold move to, support the stock and signal confidence. This capital return package they announced, it clearly blew past what the street was expecting for shareholders.
Oh, absolutely.
The big headline, the real surprise, was this massive $6 billion share buyback. Over 24 months. $6 billion.
Yeah.
That's just an enormous amount. Way more than double what most analysts were thinking.
Easily double, yeah.
So what's the signal? What are they telling us by putting that kind of money on the table now?
It's a very loud signal. Super unambiguous. They're confident in, two main things. First, that their free cash flow is solid and durable. Second, that they've made real progress getting debt down. They're below that 3x net debt target they aimed for.
So they have the room to be aggressive.
Exactly. So you combine this huge buyback with also being proactive on debt. They announced a $2 billion bond redemption too. It just screams that they think the stock's cheap. And they're absolutely committed to boosting long-term value for shareholders.
Feels like you're trying to put a floor under the stock price,
Yeah,
definitely. Yeah. And we shouldn't forget, they also brought back the interim dividend, 0.15 per share. First one since, 2019?
That's right, since 2019. It's a full court press on capital return.
A complete offensive.
Absolutely. But look, this whole strategy kind of hinges on volumes eventually stabilizing. You can't just buy back stock forever if sales keep falling. So we have to talk about where those volumes went missing, because you had some weak execution, sure, but also just a tough consumer environment in, two really key markets.
Let's start with the worst offender, China. Revenue down a shocking 15%. Volumes down 11%. Is that 11% drop just demand falling off a cliff? Or were there specific AB InBev issues at play?
Management spent a fair bit of time on this. They partly blamed it on needing to right-size inventory. Basically, wholesalers had too much beer, so they had to ship less for a bit. They also talked about channel shifts. People drinking less in bars and restaurants, more at home. Off-premise versus on-premise. Yeah. So their plan is to, fix their route to market stuff and spend more on their big brands there. But honestly, an 11% volume drop. It's not just logistics. There's definitely some kind of consumer spending weakness in China they're dealing with.
Right. Makes sense. And then let's go south to Latin America. Brazil also saw volumes fall, down 7.9%. What was the story there?
Two main things, according to management. First, really unseasonably cold, wet weather. which, doesn't exactly make you thirsty for a cold beer.
That's a fair point.
And second, just ongoing inflation hitting people's wallets, affecting consumer sentiment there.
Okay, so weather and inflation in Brazil.
And here's something important, a bit of context the market sometimes overlooks. Latin America is huge for beer. Its weight in the overall beer category is roughly double its weight in, say, the general consumer goods market, CPG.
Oh, okay. So weakness there hits BUD harder.
Disproportionately hard, yeah. So even though the CEO pointed out correctly that revenue grew in 70% of their markets, when you have volume collapsing in massive places like China and Brazil, it just kind of swamps the good news elsewhere.
Got it. So a serious volume drag in those two key spots. But if volume is falling there, how did they still manage that amazing 85 basis point margin boost we talked about earlier? Let's switch gears to the growth portfolio, because this must be the engine, right? The part that let them do that $6 billion buyback.
Exactly. It's that premiumization strategy really firing. They're just making more money on each bottle, or can they sell higher margin dollars per liter?
And the prime example has to be the U.S., right?
Yeah.
Michelob Ultra. Now, the #1 beer brand in the whole country by volume year to date, gaining share in every single state. That's a monster win.
Huge win. And they think it still has room to grow. They mentioned like 16% share in its best state, but under 6% in 20 other states. So runway there.
And it's not just premium beer, is it? They seem to be doing well in adjacent areas, too.
Definitely. Look at the no alcohol, the NA beer portfolio. Revenue up 27% year over year. That's impressive growth. And the Michelob Ultra Zero launch. Really strong. Already the #2 NA brand overall and the fastest growing one in the U.S.
Wow. Okay. And we absolutely have to mention the Beyond Beer stuff. Cutwater, their ready-to-drink spirits brand.
Oh, yeah. Triple-digit volume growth this quarter. It's getting close to $500 million in annual retail sales, and it's cracked the top 10 spirits brands in the U.S. That's incredibly fast growth in a category that's already hot and high margin.
So these things, Michelob Ultra, NA beer, Cutwater, that's how they got the 85 basis points.
That's the core of it. They're strategically selling maybe a bit less overall volume, but making significantly more profit on what they do sell.
Okay, now here's where it gets, for me anyway, really interesting. Despite all that volume pressure, the China and Brazil headwinds, management seemed pretty confident about hitting their full-year EBITDA growth target. How are they justifying that optimism? What's the thinking?
Well, the guidance was more qualitative. They didn't give hard numbers, but yeah, the confidence was definitely there. They basically doubled down on hitting full-year EBITDA growth, generating strong free cash flow, and keeping the debt reduction going. A lot of that optimism seems pinned on global inflation cooling off.
Meaning
They expect less pressure on consumers' wallets going forward. If costs stop rising so fast, maybe affordability improves, and that volume pressure eases up. They actually pointed to Mexico, where volumes started growing again in August and September. The idea is consumers there adjusted to the current prices.
So maybe the Brazil and China dips are temporary adjustments, not permanent shifts.
That seems to be the hope, yeah. A transitory adjustment to higher prices, not some structural collapse in demand. And looking further out, they stuck to their long-term view for global beer volume growth, which is usually around 1% in, normal times.
Okay. And any big events on the horizon, tailwinds coming up, what are they looking at for, say, 2026?
They specifically called out the FIFA World Cup. It's being held in North America in 2026. They called it an incredible opportunity for the category. And historically, the World Cup does give beer sales a noticeable bump, something like 0.2% to 0.25% extra category volume globally.
Which isn't trivial for a mature industry like beer.
Not at all. It's a nice little guaranteed boost.
Okay, one last thing before the trade idea. Input costs.
Yeah.
Costs of goods sold. COGS. Crucial for keeping those margins up. What's the outlook there for 2026?
They think 2026 should be a more normal year for costs. They hedge about 12 months out. Right now, that suggests maybe a bit of pressure from like the Midwest premium in the U.S.
Okay.
But they might get some help from favorable currency movements elsewhere. So net-net, the message was basically stabilization, fewer nasty surprises on the cost front, which is just what a high margin strategy needs.
Got it.
Oh, actually, before we jump to the trade, we really should mention their B2B tech platform, BE's marketplace.
Right, BEs.
Yeah, the GMV, that's the total value of stuff sold through it, accelerated, growing 66% just in the quarter. It's heading towards $1 billion now.
66% growth. For a platform run by a beer company, that's wild.
It really is. This isn't just some side project.
Yeah.
It's fundamentally changing how they deal with distributors, retailers. It gives them efficiency, better data. It all feeds back into that high margin story.
Okay, good point. Now, let's get to our segment. This is not financial advice. And fair warning, this trade idea really relies heavily on that huge $6 billion buyback acting as a solid floor for the stock price. The thinking is that this floor gives time for those high-margin growth drivers, Ultra, Cutwater, etc., to eventually win the narrative over the short-term volume worries.
Exactly. We're calling this one the ultra margin pair. So the idea, go long BUD common stock. You're betting that the sheer force of that capital allocation signal, the $6 billion buyback, is stronger than the immediate volume fears coming out of China and Brazil, at least over, say, the next 18 months.
Okay, long BED, but it's a pair trade, so what's the other side?
The hedge. You simultaneously short a comparable global consumer staples ETF, something like the XLP, the Consumer Staple Sector SPDR Fund. Yeah. You're basically betting against a basket of peers that mostly lack BUD's level of margin expansion and don't have that same massive, explicit capital return commitment.
Interesting. So long BUD, short the broader, slower staple sector via XLP. What's the core thesis tying that pair together?
The thesis is this. The market hammered BUD stock because it focused entirely on the volume risk. That risk is now, arguably, fully priced in. But what we think the market hasn't fully appreciated is the impact of that $6 billion buyback over the next 2 years, both in terms of actual share reduction and just the signal it sends. Plus, that unexpected 85 basis point margin gain, driven by Ultra, by Cutwater, it shows really strong operational chops. That discipline, we argue, justifies BUD trading at a premium compared to the plain vanilla slower-growing staple stocks in the XLP. So fundamentally, it's a bet that superior capital management and margin strength will beat out volume growth concerns in this kind of tricky macro environment.
Okay, let's wrap this up. So what does this all mean for you, the listener? BUD delivered on discipline, on margins, leading to this really quite shocking capital return plan. But the market didn't care about that as much as it cared about falling volumes, especially in China and Latin America. It suggests investors right now are prioritizing near-term demand over long-term financial engineering. It's that classic volume versus margin battle.
Perfectly put. And, while we talked a lot about Michelob Ultra and Cutwater driving those margins, maybe the real long-term kicker, the sleeper catalyst, is that B2B tech side. Remember BEs, GMV approaching $1 billion, growing 66% year over year.
Right.
So here's a final thought for you to chew on. Could the eventual profits and the data edge they get from Bs actually become a more important, more sustainable driver of margin growth than just selling more premium beer? Could they be turning their whole distribution network into essentially a profitable tech platform? That structural shift? That's something really worth watching closely down the road.
Definitely something to think about. Thank you for joining us for this deep dive. We hope this gives you some valuable context for your own decisions. We'll talk soon.